Hey, everybody, welcome to the Under the Hood podcast. This is your host, Tim Douglas. And today on the show, we're talking about Bitcoin debt funds, why the traditional portfolio is dangerous for the next 10 to 20 years, and balancing the risk between currency devaluation and market volatility. And we'll be doing that with Matt here. Matt, you ready to jump in?
Sounds great. Let's do it.
Hey, everybody, welcome to another episode of the Under the Hood podcast, hosted by Stallion Capital. This is your host, Tim Douglas, and today on the show, we have Matt Golliher, who is a financial advisor with Vista Investment Partners. Matt, how you doing?
Pretty good. How are you?
I am doing fantastic. Thanks so much for asking. And we like to jump right in to getting to know you. So if you could tell us a bit more about your story and your journey into the financial space, that'd be great.
Sure. I started my career in 2014. My first job out of college was with a life insurance company. So that's where I got securities licensed, insurance licensed, and started learning the business. And then was there for about 2 years and then spent about 2 years each at two different bank programs as a financial advisor until about the end of 2019. Started talking with the managing partner here at Vista Investment Partners, Brett Guiley, about whether it would make sense for me to join the team here. And we decided it was a good fit at the beginning of 2020. And so my first day at Vista ended up being March 23rd of 2020, which was the day Indiana shut down for COVID, and I think it was the
Yeah.
bottom of the S&P 500. So it was a interesting time for a job change. Yeah, but in hindsight, it was ended up being a good decision with some of the things that we're focused on now that would have been infinitely harder, if not impossible, if I had stayed in the legacy bank channel.
What made you feel good about that switch going into it? And also you're coming up on 4 years there tomorrow, so congratulations. But
That is 4 years tomorrow. Wow.
yeah,
You, in general, initially I didn't know at the time specifically what would be particularly beneficial about it, but I'm sure we'll talk about that later. But in general, I wanted for the rest of my career scaling my practice, I wanted to do it in a way where I felt like I had some ownership over it. I have nothing but good things to say about my previous employers, but it was more truly an employee type of dynamic with large corporation, and there's benefits to that, especially for someone first starting their career. But as I had I guess you could say matured into the role, I started to form my own philosophy around investments and financial planning and things. And so it just the ability to pursue that with more freedom and help clients in the way that I you know, saw best fit, and do things like that. So mostly it had to do with freedom and control and building the career and the practice that I wanted to.
yeah, no, freedom and control, that's key, especially when you're trying to deal with your clients in a fiduciary manner. You really need to make sure that you can be authentic and that you can continue that for the long haul so that you can give back and help their kids as well, right? The whole generational part of that. So I'm curious about where you go to stay up to date with the latest market trends and financial strategies in today's market.
I rely on a few different things. One is collaboration with colleagues. So, for example, we have a not just firm wide, but some additional advisors who join a weekly call, and we go through predictions for different areas of the market. And really, it just provides a regular way for us to bounce ideas off of each other, but then also, so to speak, call our shots in front of other people. So, helps with the humility and helps to, avoid revising what you thought you used to think and have other people, kind of hold your feet to the fire there. So that's helpful for a lot of different reasons. But one reason is just I, at least on a weekly basis, hear the perspectives of other advisors who don't think the same way that I do. And so that's helpful. There's um there's some market metrics that I just tend to check on a daily basis, around different asset classes, interest rates, things like that. And then really, I've found a well curated Twitter or X feed to be one of the best sources of news in general, but if it's tailored specifically to it, I think that applies to financial news, financial information, and things like that. And then other than that, there's usually always some ad hoc deep dive I'm doing just based on particular client needs or things or particular areas of interest. And then the final thing I would say would be trying to be regular about meeting with, or oftentimes called wholesalers, but representatives of investment companies whose job it is to go out and educate advisors about their particular offerings and what new products they have coming to the table. So a lot of different things, but I'd say that covers mostly how I try to stay up to date with what's out there in the market.
A well curated Twitter feed. That's the first time we've heard that one on the show so far, but I agree. Twitter is, you have a lot of people who synthesize information in a very succinct manner on like a Twitter thread, if you will, and it can really help with understanding the quick hits of what you need to know or introducing you into concepts that maybe, if you're not reading the New York Times every night, you may not have gotten. So I agree with the Twitter thread. It's the first time we've heard it. And so when you are meeting with other advisors to call your shots, if you will, is it primarily on some fundamental analysis of the market, like news and kind of stock stories, or is there some technical analysis in there as well? Or what's the methodology, if you will?
Yeah, the basic part of the call is just making your prediction about either the upward or downward movement of uh, stocks, interest rates, bonds, gold, oil, and things like that. So just looking at broad asset classes and making a prediction about where you think the next significant move in those assets is going to be, and offering your justification for what that is, and then later on in that call we get into specific equities that we're looking at or anything in general, and then it's kind of a free for all. So, um, it starts out real basic, and then it can go any particular direction just based on what everyone has to say. And sometimes it's not much, and sometimes we get into some really specific, you know, unusual types of things. But it's a good, well-rounded call, I think.
Yeah, very cool, very cool. And let's jump into the current market insights now. We know where you go to kind of get your information. There's Twitter threads, there's colleagues in the space, other advisors. But what factors are you really paying attention to in today's market? And then what's your high level strategy to address those factors?
The most significant ones that I track the most closely have to do with monetary policy, with the Federal Reserve, um, and fiscal deficits and federal debt. So anything related to the fiscal or monetary situation currently, in my view, is the most significant factor driving asset performance and behavior. So I'd say that's the most significant or key type of thing that I'm looking at on an ongoing basis. And as far as how I address that or try to manage that, is mostly through asset allocation. Because, for example, due to those factors I mentioned, I think it's prudent for investors to rethink what their current allocation is because um, there's a good chance that the next 50 years will not look like the last 50 years. And so just trying to be thoughtful about that and keeping that in mind when we make allocation decisions, that there needs to be some thoughtfulness related to how the future could be different from the past and not simply just modeling an allocation based on risk tolerance, time horizon, and letting it go at that.
Okay, you gotta take us into that a little bit deeper. I felt like we were dancing around something. So could you elaborate on that for us, please?
Yeah, so the way I see it now is the U.S. federal debt is $34.5 trillion. We last fiscal year we ran almost a $2 trillion budget deficit, and I'm getting the sense from the Federal Reserve, Department of the Treasury, and other agencies that they are starting to acknowledge this is a problem, even if they are saying it quietly. But when you look at historical periods of sovereign indebtedness, and look at periods where other sovereign nations have reached the level of debt or debt to GDP that we're in. Um, it's interesting because there's a few theoretical ways to right the ship. You can increase tax revenue, you can tighten your belt through austerity, uh, a few other things. But historically, there really is only one way out of it, which is to suppress interest rates below the rate of inflation and inflate the debt away. And there's a term for that called financial repression that goes along with that. But specifically, as far as asset classes go, the one that I have a critical eye on is traditional fixed income because I think there's a significant chance that the real return of traditional fixed income could be negative for the decade or several decades ahead. So that, as far as concerns go in investor allocations, that's the piece of it that I would say I'm most concerned about.
So you think the bond market will be negative in the foreseeable future?
In real terms, yeah. So even if interest rates remain positive, and the number of dollars in your account is going up. As far as fixed income goes, I think there's a significant chance. Of course, nothing's sure or guaranteed, but I see it as a significant chance that holding bonds will lose wealth over the coming decade or couple of decades.
That's just because of the financial climate we're in, and that kind of really only one practical way out of it, of having to adjust those interest rates to suppress or to kind of wait out inflation, if you will.
Yeah, and we that's what we did after World War II. A lot of people compare the current inflationary environment to the 1970s, but Lynn Alden and a few other analysts that I follow and enjoy their work, they make the point that it's more analogous to the 1940s for a couple of different reasons. But one of those reasons is that we did not have such high debt to GDP in the 1970s. So when Paul Volcker jacked interest rates to the sky in order to combat inflation, it induced a period of stagflationary recession, but it at least appears like that did the trick. Inflation did moderate and return to more of a normal baseline. But the challenge with doing that now, where Jay Powell raised interest rates to combat inflation, but because there's so much federal debt, what that means is that the federal government has to refinance that debt at the higher interest rate. So our interest expense on the debt is now around $1 trillion, but that means that treasuries are pumping $1 trillion of coupons into the economy, which is stimulatory. So, in a lot of ways, the interpretation I find most convincing for why asset prices have not become impaired despite the higher interest rate environment is because fiscal deficits are counteracting monetary tightening. So, the fiscal side is offsetting the Federal Reserve's current policy.
I see. Oh, dude, that makes so much sense. Thank you for explaining that in the
Yeah.
way you just did. And so then that makes the bonds negative in real terms because are we going to have to continue to raise interest rates or just keep them at the level we're at? Kind of go connect those two dots for me.
There's a few different ways it could look. Historically and throughout the world, you could, for a prolonged period of time, artificially suppress interest rates below the rate of inflation. Because if you're, inflation, the benefit of it from the federal balance sheet is that even if real growth in the economy is zero, if inflation is 5%, well, GDP will grow 5% in nominal terms just because of devaluation of the currency. So that's not real growth, but it does produce a real nominal increase in tax receipts. If you think of tax revenue as, a relatively stable percentage of GDP, which it has been in the US for decades, um, what that allows you to do if interest rates are lower than inflation is increase your tax receipts faster than your debt is compounding. And so over time, you get to a more healthy, sustainable debt to GDP level. So you could do that steadily over a long period of time. There have been nations like Israel and others, for example, that had very short, severe bursts of inflation of 100% or more. And so you can you can rip the band-aid off like that, or you can, it can happen slowly, and oftentimes that's not a purposeful calculation. It's a matter of trying to manage that and ensuring nothing goes too wrong. But when I look at the available solutions, like I said, federal agencies are now acknowledging that this isn't sustainable. Um, they're not offering particular solutions because most of the ones that are typically talked about are very politically unpalatable, like cutting entitlements or raising taxes. But mathematically, I don't think either of those are viable anyway. I think the path forward, at least the only viable one I see, is financial repression, like I talked about.
Absolutely. And you said your strategy for really addressing that in the market is portfolio allocation. And we talked about how you are consistently talking to fund managers. So are those two linked? Like it's primarily looking at the alternatives? Are you kind of allocating to certain equities that you think will give you an edge? Talk to us about that portfolio allocation in the face of that current market state.
Yes, the biggest thing, and this relates back to something I said earlier, where I'm glad I came to Vista because shortly after that, in 2020, I, for the first time in my career, took a serious look at Bitcoin and started learning about it, and realized that I was wrong about it. In 2017, when it had a massive price run up, clients first started asking about it, and I essentially told them it was digital beanie babies, purely speculative, not a suitable place to store wealth for the long term. And it was in 2020 where I actually did a deep dive in trying to figure out what this thing was, and realized that I was wrong and this is important. And I eventually came to the conclusion this is probably the most important financial innovation that will happen in my career. And from a timeliness perspective, it just also so happens to coincide with the inflationary risks that I talked about. Because for listeners who don't know, Bitcoin is money you can't print. There will only ever be 21 million. So that offers particular diversification benefits when a primary concern is inflation in the future.
It's not so much alternative investments. I'm sure if there's some of that, you listen to wholesalers, but it's more like understanding currency and then understanding where opportunity may lie in the future with some of the Bitcoin, some of the technology that is innovating the financial space.
Yeah, I would say so. And there's, unique or new Bitcoin financial services that are emerging. Private credit funds that provide U.S. dollar liquidity for Bitcoin-backed loans. That's an alternative investment that we're looking at and doing due diligence on because it's interesting. So there are things that Bitcoin enables to exist that could not have existed before in the alternative investment space, but Bitcoin itself, Bitcoin specifically, looking at that as an asset, I would say that is my primary way to address the key market factors that I outlined.
Okay. Okay. And then usually we go into, given the current state of the market, how are you looking at risk? But would you say the answer that we've already talked about also answers that question, or do you want to add to that?
I'll add one thing to it, which is I try to think through. When I think of risk, I think it's a matter of striking a balance between different kinds of risk. Because when we talk about risk, the key question is risk of what? Is that risk of a you know severe but temporary decline in portfolio value? Is that the risk of permanent loss of purchasing power over a decade or two? And the way I see the trade off is primarily a trade off between the two types of risk, which are market volatility risk and monetary dilution risk, where if you're so hyper conservative that you can't stand a much volatility in your portfolio, what you end up doing is overexposing yourself to erosion of purchasing power. There really is no single asset that can shield you fully against both. Um, So it's a matter of really trying to be thoughtful and intentional about how much of each type of risk you're willing to be exposed to.
Yeah, that makes a lot of sense because it's either you have kind of a stable, safe investment that's probably a lower yield
Hmm.
and is probably close to inflation or just barely keeps pace with inflation or maybe a little bit of a premium. And then you have the more risky investment where it's like, okay, if you only did safe, you wouldn't have enough buffer of like, hey, this has a huge gap and can smooth out returns over inflation. But if you only did risky, you could lose it all, of course. That's always the case with investing. So I like how you put those two types of risk uh, together. And that was currency devaluation risk and then market volatility risk. Is that right?
Yeah, and a simplistic example or way to think through it is if you imagine two investors a decade ago, one of them kept $1 million in their checking account, the other put $1 million into an S&P 500 index fund. Um, one investor is going to sleep like a baby every night because they know they're going to wake up and their account's not going to go down. But you fast forward 10 years later, and in terms of purchasing power, they've lost half their money, two-thirds of their money if you price it in houses or cars or any other scarce desirable good or service. Um, if you discount it by CPI, they come out looking better, but for most people, they aspire to own more things than exist in the S&P or in the CPI index. So I think it's more appropriate to calculate your own inflation rate based on what you buy or what you want to buy. And from that perspective, someone in cash over the last decade, they lost half their money, even though
Yep.
they didn't have any market volatility risk.
Talk to us about that. Are you like literally look at your bank account and your monthly expenses and like judge your inflation on those monthly expenses? Is it just desired future purchases? Like if I never want to be a owner, then I shouldn't look at that. Talk to us about calculating your own inflation rate.
I've done it a few different ways. One way is since 2020, I've tried to be intentional about keeping my receipts because when I'll oftentimes talk about something called the winemaker's dilemma when it comes to inflation. One of the problems with CPI, besides just the calculation methodology, is that it only measures the observed increase in consumer prices. But in reality, businesses react to rising prices in more ways than raising their retail prices to consumers. They can also make less profit, so they can eat the cost and just have a smaller profit margin. They can pass on the cost to their end consumer, which is what CPI measures, the end increase in retail prices, or they can dilute the quality of their product. That can play out in some subtle ways, but one politically salient example, because I think it made the news a little while ago, is something called shrinkflation, where used to buy a 12-ounce widget and now it's 10 ounces. So they've reduced the amount of the product as a way to avoid raising the retail price. So that's one. There's alternative metrics you can use, but really I try not to focus too much on actually calculating, down to a percentage what it is. I just look at things I'd like to own at some point in the future. And I notice that, if all the stuff I want is going up in price by 10, 15, 20% per year, do I really care what a basket of goods the Bureau of Labor Statistics keeps track of if that's only going up 3 to 5%? I don't care. Um,
Yeah.
so it's more about that, just thinking, what do I want my life to look like in 10 years and how fast is the price of that going up?
It really is interesting because you had homes that doubled in Austin in like 2 to 3 years, right? It's
Hmm.
like went from 300,000 to 600,000, or you can't walk anywhere without finding an $800,000 house now. And it's like,
Yeah.
man, if you were looking 6 years ago and you wanted to be a homeowner, you might have been saving one way or thinking about earning this way. And then the home price doubles and maybe your income didn't if you weren't like skilling up and climbing the ladder. And so your investments probably didn't either. And so it's just I think that's a good method of looking at, hey, what do I want to buy? How much has that increased year over year and for the past 5 or 10 years? Because um, Specifically, home prices in Austin. I'm feeling that one.
Yeah, real estate. Yeah, last 5 years is I think a great example. Anyone who's saving up for a down payment on a house, really, CPI means nothing to you because
Yeah.
if that's your purchasing power metric, then when you look at that, the inflation rate for that person is 20 to 30%, depending on the market.
Yep. Absolutely. Well, cool. I think we've talked a little bit about current market, what to pay attention to there, also kind of how you address risk given the current state of the market, and specifically your perspective on risk, which was very helpful for me personally. Um, Typically, now we would go to how you're looking at portfolios when it comes to a client who wants to accumulate assets versus a client who wants to get income from their assets. Do you want to speak to that, or do you want to jump to alternatives?
One thing that plays into some of the things we talked about before for accumulation, I think it's a matter of helping the client maximize long-term rate of return potential, but doing it in a way where they're not subject to so much volatility that they don't hold for the long term. So that's the balance I try to strike there. And for some of the reasons that I talked about, looking less at or minimizing exposure to things like fixed income or things that I think will dilute their wealth over time in real terms. And now the big thing is working to integrate Bitcoin into those portfolios. For for someone who's retired, the primary thing or the primary shift is helping them to reduce their sequence of returns risk, where when they were accumulating, it didn't necessarily matter, or it shouldn't matter all that much what their portfolio does on a month to month or even year to year basis. But if they're pulling income off that portfolio, now suddenly it matters very much. So helping them reposition assets, growth assets into income producing assets, whatever that might look like. That would be the primary difference I'd say in how I see helping someone in the accumulation phase versus distribution phase structure their portfolio.
Well, I do want to hear a bit more about the Bitcoin alternative that you talked about. So, we always like to start with hearing about how you do the due diligence on some of these opportunities. So, when a Bitcoin debt fund, for example, comes to you, what are the things that you're looking at to really evaluate that investment opportunity?
In general, with alternatives, I try to look at a few different things. The first question I like to ask is, does this solve a particular investment need for the client that cannot otherwise be solved with conventional or traditional assets? Or does this alternative investment, is it likely, do I believe it's likely that this will enhance the risk net of tax risk adjusted return profile of this portfolio? Um, those are the two areas where I'll look at an alternative for a particular client and say this might make sense for them. And then the other question I try to ask is, how can the client get screwed on this? Really trying to understand what could go wrong. If it does go wrong, what does that look like? And digging deep into that, because in alternatives, they can have unique risks, and it's important that the investor understands what those risks are. So
Mhm.
in general, those are the things I look at when I'm reaching out beyond the traditional equity fixed income type of solution.
Does it solve a unique need? Can they get screwed? Or not can they, but how can they? Because every investment has risks.
Mhm.
And then what was that third question?
If a client's just looking to improve their portfolio, it's do I is there good reason to believe this alternative investment will enhance the net of tax risk adjusted return profile? Um, or the on the flip side is, are we trying to solve for a specific investment need, and does this alternative do that in a way that can't be accomplished with conventional or traditional investments? And then so that depends on what the client's using the alternative for, and then always trying to look at what can go wrong. What are the risks?
It sounds like the role alternatives play is like needs to solve a specific issue that traditional investments do not, or it needs to improve the net after taxes risk adjusted return for the client. Would you say those are the only two roles an alternative can play, or are there other roles that you look to alternatives to play in a client portfolio?
I'd say those are the two primary roles that I look at. Because in the absence of one of those, my bias is towards simplicity. And in a case where we're not accomplishing either of those two things I mentioned, oftentimes I'll look at that and say I am unnecessarily increasing the complexity of this client's portfolio or financial situation for no obvious benefit. And in that case, in the absence of a clear reason to use an alternative, I do tend to stick with more conventional, traditional types of assets.
Do you think there's a world in which alternatives, and this is completely off the wall question, so maybe the answer is I have no idea, but where alternatives are just as convenient and accessible as traditional investments? Because I think of platforms like iCapital and a couple of other platforms that make alternatives very accessible for advisors, where it's basically like click of a couple buttons, they helped on the due diligence, maybe they did a report or something like that. And so I feel like it's getting there more than it was 20 years ago. And what do I know? I'm 24, but from what I've heard, right? So do you think that that world is possible?
I think it's possible, and we're moving in that direction. And so, the definition of alternative investment, I think, will has changed and will continue to change. I mean, it depends on how you define it. Some people would classify alternative investment as anything that's not a equity or fixed income type of asset. And other people would define it differently. But yeah, I think we're getting to the point where especially retail investors, especially who are just starting off, don't necessarily have a massive amount of capital to deploy. Um, they already, at their fingertips with their smartphone, have access to so many more things than they could have invested in just 10 years ago. So, yeah, I think that's possible, and I think we're moving in that direction. What that ends up looking like, I have no idea, but
Yeah, we had Kyle Kadish on the show not too long ago, and he was talking about how he doesn't even like the word alternatives because he's like, there's only two ways you can hold an investment on a balance sheet. It's either equity or it's debt. And kind of saying it's an alternative automatically can have a negative connotation for
mm-hmm.
some investors when it's like, no, this is a good investment for your portfolio and it's equity or debt. And you understand having equity and you understand what debt looks like because you've had a mortgage before. And so he just had a really interesting take on it.
Yeah, I think that's a good point. There are alternatives that I could try to make the case are less risky than non-alternative versions of it.
Yeah.
In some ways, I mentioned the private credit fund we're looking at that provides U.S. dollar liquidity for Bitcoin-backed lending. In a lot of ways, I consider that less risky than traditional fixed income um,
Yeah.
due to a lack of credit risk, which we can go into that if you want. But yeah, I think that's a good point. There's definitely a negative connotation sometimes when you talk about alts.
Yeah, yeah. No, please go into it. Talk to us about the lack of credit risk with that particular investment, and because I'm sure some people are like, "Ooh, that was a hot take there, Matt." All right, so go for it.
Yeah, so digging into a specific type of alternative investment, with the key idea is to think of Bitcoin as pristine collateral, where a lot of private credit funds, oftentimes they provide liquidity or loan funds to real estate projects. And whether it's real estate or anything else, typically any type of private credit will involve credit risk because you're loaning money to someone to do something productive with it and generate a return, but there's a chance that they won't be able to do that, and that's the risk in all forms of credit usually. But with Bitcoin, the interesting thing about it is, unlike physical real estate, it trades 24/7. It's very liquid compared to most other assets, and it's globally attractive. Where wealthy people in Japan don't really care about your um, multifamily units in pick a city, wherever it is. Wealthy people in Japan or Singapore or wherever don't care about that. They do care about Bitcoin. And so when you think about it from the standpoint of property, it, I would argue, is the most liquid, universally desirable property on earth from that perspective. But the other unique thing about it is that it's digital. And what that creates is an opportunity for Bitcoin holders who, for whatever reason, oftentimes it's to avoid a capital gains tax liability, but they own a lot of Bitcoin, but they want some dollars or dollar liquidity. So there are there are companies that are forming and developing. You know, one of them, the leader in the space, has been around for 7 years now, I think. But they provide a way for Bitcoin holders to lock up their Bitcoin in a custody arrangement and loan dollars against it. The unique thing about that, though, is unlike loaning dollars against cars or real estate or any other form of collateral you can think of, you can repossess the property in a second and it costs nothing. So when you look at the impairment risk of most forms of private credit, it's significant at least, or something. But the largest player in that space, as far as Bitcoin-backed lending, which is what the private credit fund that we're looking at uses, they've loaned out $660 million, I think, um, in origination on those types of loans, and have had zero impairment loss.
Wow.
And they yield higher than private credit funds that invest in real estate. So, of course, there's still risk. That firm could not execute the margin call correctly, or there's things that could happen for sure. But the part that's so interesting to me about that specifically is you don't really have to care about the credit worthiness of the borrower, because the issuer of that loan has full control authority over the collateral and can liquidate it 24/7 automatically if they fall below the margin requirements. So I want to be careful here, because there is certainly risk in every investment, but from the point of counterparty risk, credit worthiness is not part of that, and that's something we've never seen before in terms of a debt investment. Um, the only risk is execution risk on the part of whoever is originating that loan.
Yeah, because they can recall their collateral immediately, and um, so it doesn't really matter if the borrower messes up or not, and that is a huge shift, huge shift. And I guess other people would say, what about the currency devaluation of Bitcoin? Like, is that a stable thing to lend on in and of itself? Because it is volatile.
So the way most of those work is they do over collateralized lending. So loan to value ratio of 40%, and then if Bitcoin falls 40%, you get a margin warning. If it falls below a certain level, you have 48 hours to post additional collateral. And if it falls below a certain point where it starts to get close to the principal amount of the loan, it's automatic liquidation, which is triggered through software. And like I said, Bitcoin trades 24/7. It's mark to market on a continual basis. So um, from that perspective, it's a night and day difference compared to you loaning someone else money for a piece of real estate development, because that's not mark to market on a continual basis. And in the event where they do default, well, you have a project on your hands now. You
Yep.
can't flip a switch and recall the collateral and liquidate it instantaneously, but you can do that with Bitcoin.
Yeah, absolutely. Well, we're going to jump back to your firm a little bit. We've talked a lot about it and how it provided you the opportunity to kind of freedom, control, kind of move your investment thesis how you want to. But what would you say really sets your firm apart from other financial advisors?
The biggest thing now is we're in the process of launching a DBA under our existing RIA that will provide Bitcoin focused wealth management solutions. So our web presence is a little sparse now. We haven't tied up all the bows to get that new brand public facing and things yet. But once we do that, that will be the primary distinction, I think, between us and other wealth managers. Is we are one of the first ones in the space to do that. And as far as RIAs that also have the ability to offer brokerage and insurance solutions, as well as actual spot Bitcoin that the client could withdraw into their own custody if they so chose. Um, when you check all those boxes off, I'm not aware of any other firm that meets that description. So we're either all by ourselves or in a very small category there. So I think that's our biggest distinction.
And what do you think is most important to that client advisor relationship?
A few different things, but one of them that popped into my mind is worldview, or how you see the world. I think values uh, goes into that some, but I've worked with a lot of different clients in my career, and I've seen investors work with a lot of other advisors, and um, that's one of the big things where you could have a very good client and you could have a phenomenal advisor, but just due to they don't see the world the same way, they don't value the same things. As a result of that, don't have a great working relationship. And that plays into so many different things. But I think that's been my focus uh, for the last several years. And when I left the bank channel, that was my primary focus. To whereas before I helped everybody. Any bank customer that needed it. I was the investment guy. I was the advisor. Um, but when I talk about really trying to scale my practice the way that I want, a big part of that is finding the niche of investors that I can best help and that I most enjoy working with. And I didn't know at the time what to be, but related to Bitcoin, that is now the target niche that I'm looking to serve is Bitcoiners who also own traditional financial assets.
I love it. Well, Matt, thanks so much for coming on the show, man. I think that's all we got for you.
All right, that sounds great. Well, thanks for having me. I really enjoyed the talk.
Of course. And if people want to find out more about you, where should they go?
Yeah, I mentioned our web presence is a little sparse now, so our new website is not yet live. But what I've been saying for the last couple of weeks is that if anyone has questions or I can be helpful in any way, right now I'm encouraging them to reach out by email. So I can give that here, or if you want to pop it in the show notes, whatever works best.
Yeah, how about you say it here and we pop it in the show notes?
Yeah, so my email is matt.golliher at vistainvestment.net. That's tt.golliher at Vista, V as in Victor, ISTA, the word investment, singular with no S, .net.
There we go. And that will be down in the show notes for you guys who don't want to have to rewind that and get that three times. So, yeah, Matt, thank you for coming on the show. Everybody else, thank you for watching. And we will see you guys on the next one.